In the United States, most financial stress does not come from a lack of income. It comes from a misunderstanding of how money actually moves through a household or business over time. A man earning a strong salary can still feel constant pressure, while another earning less appears calm and financially steady. The difference usually has nothing to do with how much money shows up on a pay statement. It comes from how cash enters, pauses, and exits real life. Income is a number people recognize easily. It is printed on offer letters, tax forms, and marketing materials. It creates status and confidence. Cash flow is quieter. It operates in the background, determining whether obligations feel manageable or overwhelming. Many people treat these ideas as interchangeable. They are not interchangeable in practice. Consider a working professional in the United States earning $120,000 per year. On paper, this income places him well above the national median. Yet every month feels tight. Housing costs leave the account quickly. Transportation expenses arrive on fixed dates. Subscriptions, utilities, and family responsibilities pull money in predictable but relentless intervals. When unexpected costs appear, the margin is thin. The income is high, but the movement of cash creates fragility. Now consider another man earning $75,000 annually. His income looks smaller. However, his expenses are aligned with timing and flexibility. Payments are spaced. Fixed obligations are limited. Cash remains available after essentials are covered. The second situation produces more stability despite lower income. This difference reveals the core issue. Income measures earning capacity. Cash flow measures financial breathing room. Income is episodic. It arrives at intervals defined by an employer or contract. Cash flow is continuous. It reflects timing, sequencing, and durability. A person can earn well and still experience negative cash flow during critical periods. When that happens repeatedly, stress compounds even if annual income appears strong. In the United States, many households structure finances around income alone. Decisions are justified by salary figures rather than by cash timing. Large housing commitments are approved because income qualifies. Vehicles are financed because income supports approval. Long-term obligations are stacked based on gross earnings. What gets overlooked is how many dollars remain available at different moments during the month. Cash flow instability rarely announces itself dramatically. It shows up quietly through reliance on short-term borrowing, delayed payments, or constant account monitoring. These behaviors are symptoms of timing imbalance rather than income shortage. A useful way to understand this is to separate money into three roles. First is earning. Second is holding. Third is releasing. Income governs earning. Cash flow governs holding and releasing. Stability comes from the second and third roles functioning smoothly. In practical terms, this means that two people with identical incomes can experience radically different outcomes depending on how their cash moves. Fixed expenses create rigid release schedules. Variable expenses create uncertainty. When release schedules cluster tightly after income arrives, cash evaporates quickly. When release schedules are spaced or reduced, cash lasts longer. This matters even more for self-employed individuals and business owners in the United States. Revenue can appear strong on an annual basis, while cash flow remains inconsistent. Clients pay on delayed terms. Expenses arrive earlier than expected. Inventory must be paid before revenue materializes. The business shows profit on paper, while the bank balance struggles. Professional investors understand this distinction intuitively. They rarely judge financial health by headline income numbers alone. They study timing, durability, and control. They ask whether cash enters before obligations require release. They examine how long cash stays available before being committed elsewhere. Stability is created when cash arrival precedes cash release with enough margin to absorb variation. Income does not guarantee this condition. Cash flow design does. This is why high earners can feel trapped while moderate earners feel flexible. One relies on income volume. The other relies on cash sequencing. In the United States, tax systems, payroll structures, and consumer financing all reinforce income thinking. People are taught to maximize earnings. Less attention is given to smoothing cash movement. As a result, many households optimize the wrong variable. Cash flow stability does not require extreme frugality or deprivation. It requires intentional structuring. This includes aligning payment dates, reducing fixed obligations that activate simultaneously, and preserving optionality in spending decisions. Optionality is a critical concept. Cash that remains uncommitted retains optionality. Once cash is assigned to fixed obligations, flexibility disappears. Income increases often lead to more fixed obligations, reducing optionality despite higher earnings. This explains why lifestyle expansion frequently undermines stability. Additional income is converted into permanent releases rather than into retained flexibility. The household feels wealthier but becomes more fragile. A stable financial structure prioritizes resilience over appearance. It accepts lower visible income utilization in exchange for smoother cash behavior. This approach is common among disciplined operators and long-term capital allocators. Cash flow stability also affects decision quality. When cash is tight between income events, decisions become reactive. Opportunities are ignored. Costs feel threatening. When cash remains available, decisions become deliberate. Risk is assessed calmly. This psychological dimension is often overlooked. Cash flow affects cognitive load. A man worrying about timing is not thinking strategically. Stability frees mental bandwidth. In professional finance, liquidity is valued precisely for this reason. It is not about maximizing returns every moment. It is about surviving variability without forced action. Households face similar dynamics. Income alone cannot provide this protection. Only cash flow design can. Understanding this difference shifts priorities. Instead of asking how to earn more, the better initial question becomes how to keep cash available longer. This reframing changes everything from housing decisions to contract terms. In the United States, where income volatility has increased for many sectors, this distinction matters more than ever. Stability is built through control of movement rather than growth of numbers. This sets the foundation. The next step is understanding how to engineer cash flow deliberately rather than accidentally. Once the distinction between income and cash flow becomes clear, the focus shifts from earning more to structuring better. This does not mean rejecting income growth. It means refusing to let income increases automatically convert into rigid commitments. The first principle is sequencing. Cash should enter before obligations require release whenever possible. For salaried workers, this means aligning major payments after income arrival dates. For independent earners, this means negotiating payment terms that reduce delays. Small changes in timing can dramatically improve stability. The second principle is compression awareness. Compression occurs when multiple fixed expenses activate within a narrow time window. Rent, debt payments, utilities, and subscriptions often cluster early in the month. This creates artificial scarcity, even when total income is sufficient. Spreading obligations across the month reduces pressure without changing totals. The third principle is variable protection. Variable expenses introduce uncertainty. Food, transportation, and discretionary spending fluctuate. When fixed obligations consume most cash early, variable costs feel dangerous. Preserving margin protects against this volatility. Margin is not excess, it is buffer. Professionals treat buffer as a requirement, not a luxury. Another critical factor is obligation reversibility. Some expenses are easy to reduce, others are rigid. Financial stability improves when rigid obligations are minimized relative to flexible ones. This allows adjustment during disruption without structural damage. In the United States, many households reverse this balance. Housing and vehicle commitments dominate. Flexibility shrinks. Cash flow becomes brittle. Income disruptions become crises. For business owners, the same logic applies. Long-term fixed costs should be supported by durable cash inflows, not optimistic projections. Flexibility allows adaptation when conditions change. Cash flow also interacts with opportunity access. Investments, education, and strategic moves often require available cash at specific moments. Income that is fully pre-allocated cannot respond. Cash flow stability preserves optionality. This explains why some individuals with modest incomes accumulate assets steadily while higher earners stagnate. The former retain deployable cash, the latter convert income into obligations. Another overlooked element is emotional signaling. Income provides external validation. Cash flow provides internal security. Many people prioritize the former because it is visible. Stability requires prioritizing the latter, even when it feels less impressive. This shift requires discipline. It involves saying no to certain upgrades. It involves evaluating decisions through timing rather than total cost. It involves resisting automatic lifestyle escalation. Over time, this approach compounds quietly. Cash buffers grow. Stress decreases. Decision quality improves. Income growth, when it occurs, strengthens the structure rather than straining it. This is the core reason cash flow matters more for stability. It governs survival during variability. It enables calm responses. It supports long-term positioning. Income remains important. It expands possibilities. But without proper cash flow design, income becomes a fragile pillar. With proper design, even moderate income becomes powerful. In the United States, where financial systems reward income signaling, choosing cash flow stability is a strategic advantage. It produces resilience that does not depend on constant growth. The goal is not minimalism. The goal is control. Control of timing, control of commitments, control of options. When cash moves deliberately, stability follows naturally. That is the quiet difference that determines whether money serves life or dominates it.